Hello and welcome to my new lecture, Timeframes. And here I will talk about how we can look at higher timeframes to look at what trade we have to take. So by that I mean is that we will look at high time frame, go to the lower time frame, and frame our trade. On the higher time frame, we will find the PD arrays, ICT PD arrays on the higher time frame, find some key levels, and then based on that, during our time of interest, we'll see if we are at that level, and if we are at that level, we will try to enter the trade. Okay, so we'll talk about how we can use higher time frames for that. Now, in the previous lecture, we mentioned how the price moves in years, months, weeks, days, and sessions, and however it moves, you can see that in the lower time frame, and that's why we call price as being fractal. Price is being called fractal because it moves similar in all of those time frames. It can be a daily time frame, a weekly time frame, or an hourly time frame, whichever time frame you use. But each time frame takes its respective time to create. For example, a daily candle takes a day to form, an hourly candle takes an hour to form. But we are day traders, we only want to trade at max an hour. So what we do, we will use those bigger time frame candles to look for the direction we want to go in and go to the low time frames like 1 minute, 5 minutes and frame our trade. And for that reason, the example that I'll be using in this trade, I need you to remember from my previous lectures that why price moves is because of liquidity or imbalance. Price hunts liquidity, and when it hunts liquidity, it wants to rebalance. When it rebalances, it goes toward liquidity, and that's what it do all the time. Now, just a small breakdown. We talk about from the daily candle. A daily candle has 6 4-hour candles. 4, 6, 24. There are 24 hours in the day. There are 23 1-hour candles. Now, why 23 is because there is 1 hour that the market is closed from 5 to 6. Then there are 92 15-minute candle based on this, 276 5-minute candles, and 1380 1-minute candles. So you have a lot of opportunities in all of that. Now, I want to give you an example of how we can look at a daily chart over here and a 4-hour chart here. So I want you to know that this section over here on the left is the daily chart, while the section on the right is a 4-hour chart. And I have added these lines here for your reference on to when we reach that place. So let's suppose on this down day, we went up and down. So first we went up, we made a high, then we kept going down, 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 down. That's when we made that low over here. And as you can see, we moved up again. We did not close here. We actually moved up and then close over here. So we move up again a little bit and then come here and close over here. The next day starts from the same place and goes up and down and then come back up and closes. So here we open over here, we go up, we go down, and then we come back and close. So it's a bullish candle because we closed above the previous opening price. And then we go up, so we open, we go up. So that would be a bearish candle where we make a high, which is this high over here. And then we go down, make a low, which is this low over here. And then we go back a little bit up and close over here. So this is a bearish candle, and then the next candle goes on. This is how you look at how a one candle on one time frame can be a lot of candles on the other time frame. Now I want to show you how it works. I added a video to show you how that will work. Okay, so here you see we have 4 hour chart, and I added a high time frame indicator showing me the daily chart. So as you can see, we are on this bullish candle, which is this 6 candles, the bullish candles, and now we'll go towards the next day. The next candle opens, we go up, we go down, we keep going down. Keep looking at how these candles, and there is only one candle here. We go up, we go we close, we open a new candle, we go up, up, go down, up, we close, bullish candle. The next is a bearish candle, we make a high, and then go down, 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 and that's how we're done. So you see how there is one daily candle, you saw 6 4 hour candles. Now to make it more solid, I added another understanding of a 4 hour to 1 hour chart. So let's watch this video as well. So here you would see that the day opens, the 4 hour candle opens, we go up, make a high, go down. Now we need 4 1 hour candles to create one 4 hour candle. As you can see, we have 8, 1, 2, 3, 4 with 16 candles. Now we'll see 20 candles, made a low, go up, and then we close for the day on the next candle, and we stop right there. Okay, so here what you can see is how you know the direction, right? But you don't want to wait for 4 hours. This is our time of interest. We go down into this imbalance over here. As you can see over here, in the next 4 hour candle we go up. So what will be our draw from here? This 4 hour fair value gap, or you can look at the 1 hour, and you also have a 1 hour fair value gap, right? So you can frame your trade from here to over here. Now let's take an example. Let me replay that again. Let's take an example from one of the trades day that I had. This is which day it is. This is the Friday of the last week, where I had these levels from the previous day week. This is something new that I learned from ICT recently, where he would grade the wicks of the daily candles. Now I was bearish on the day for that time when I was in the trade. The reason for that is bullish on the day, but I wanted to frame a trade because it was supporting my trading levels over here. We had an imbalance, we open up, we go into that area, and then I want to see a reaction from that. So on an hourly chart, you can see over here, we went to the 0.5 of that wick. After opening from here to here, and then we go down, close below this wick over the lowest quadrant of that wick. We have the imbalance noted out over here, and in the next macro I'm looking for an opportunity. So here, as you can see, I took a trade, and I want you to pause for a second and see which trade I would have taken, and then I will add the lipstick over there. All right, I think you paused, but if you did not, you're missing an opportunity to learn. Here it is. We took out this high over here, right exactly at 11:45, which is a macro time. We went into that breaker, we went into that imbalance. They were all aligning next to each other, and we went into the lowest quadrant of that wick. I entered on there, and then I waited for the imbalance that is over here. And in those 30 minutes, we moved a lot. We moved from 154 to 26,000, which is almost 150 points. And that's where I ended my trade. The chart kept on moving and then came back. That's why we have a bullish day. So from here, I want you to understand a few things. One thing is that you can use any time frame you want, whichever you're comfortable with, but I use these ones, a daily and a 1 hour and a 1 minute chart. Daily I use for the wicks and the imbalances that I see. The hourly I use to see the structure break and all that. Like, look at this. We have a break of structure over here. So I'm bearish now. So I want to go down towards this order block over here. You see, we make a fair value gap, we tap into it here, and then we move down. This is institutional order flow and drill, as explained by ICT, where the institution would tap into the fair value gap and instantly move away. That's what happened over here. And then we drop down. Okay. All right, that's how you can look at higher time frames. You can have a daily time frame, and you can decide you want to look at 4 hours, 1 hours, daily, whichever you feel like is good for you. For me, I look at the daily and hourly and 1 minute chart. And I showed you an example out of it, that on a daily I was looking for those quadrants to be filled, and on an hourly I was looking for a break of structure, and during my time of interest I want the price to come back to one of the big quadrants so I can take a trade. And then we talked about how the price moved, which we were just discussing. Now what I want you to do is go on your charts, whichever you like, label the higher time frame PD arrays, like a daily wick, a daily imbalance, an hourly fair value gap, an hourly breaker, whichever you like, whichever you want to trade, right? It's up to you which you want to trade. And different levels, like I added those wick levels on the chart. Now I want you to notice how the price reacts to those levels whenever the price goes to those levels. And I want you to look at those prices during your time of interest, which can be any macro on the day, whichever you trade in. Like it can be the morning macros, the PM macros, the lunch macro, the London macro, all of those. Note how it reacts in that time, and then find different examples for that. And with that, we can end the lecture, and I will see you in the next one. That would be fairly quick because I want to upload the next one as soon as possible because I missed a week. See you then. Good day, good trading.